Hi, I welcome you to Caroline's Online Academy. This is the 8th video in the series of Basics of Accounting. Today we would be looking at Golden Rules of Accounting. I request you to watch the other videos also, the 7 videos, because I'm going to be taking references from those videos and explaining this. Understood? Now, what we mean by Golden Rules of Accounting is, before I get to that, let me tell you what accounting is. Let me remind you what accounting is. Accounting is an art of recording, classifying, summarizing transactions of financial character in order to communicate that to the stakeholders, right? Now, the first step in accounting is to record. Like in our first example, when I told you about Dhoni recording everything in a notebook and then later classifying, okay? So the first thing he does is record it in one notebook as the transaction take place on the basis of time, that is in chronological order. And then he classified it into different notebooks, right? So while recording, there was no hard and fast rule as to how an accountant is supposed to record, and every accountant recorded it as per their wishes. So that created a problem because no other accountant could understand what a certain accountant has recorded in the notebook in which he was recording. We're going to call that notebook in which we are recording for the first time, recording the transaction for the first time as journal, Journal. Okay, we're going to call that as journal. So when people realized that this was a problem and there should be a universal rule which every accountant should follow, so that anybody who records will be able to convey what he has recorded to anyone else who's reading, provided both of them have knowledge about the accounting rules. Understood? So they wanted to create some rules. Now they thought about how to create those rules. Like they should create it on transaction basis or on account basis or some other basis. Like what I mean to say is, like, what if you created a specific rule for every transaction? So if that transaction takes place in your business, you should refer to the rule and record the transaction according to that rule. Can you do it transaction specific? If you ask me if you can do it transaction specific, I would say it is not possible to do it that way. Why it is not possible to do it that way is because in a business, a lot of transaction take place, different kinds of transaction take place in a single business, correct? Similarly, in various kinds of business, various number of transactions take place. So the number of rules that you will have to create is exponential. So that is not possible. So you cannot create transaction specific rules on how to write a particular transaction. Understood? So they thought about creating it on the basis of accounts. Again, in one business itself, many accounts get created. So that is also not possible. But we all know one thing about a transaction. A transaction is one in which economic benefit flows from one source to a destination. And the notebooks that are going to get affected, or we're going to call those notebooks as accounts. For instance, if I pay cash to purchase groundnut, I'll first record it in the journal as I purchased groundnut, and then I'll write it in the cash notebook and groundnut notebook. In groundnut notebook, I'll write that I have received groundnut, and cash notebook, I'll write that I've spent money, right? So these two notebooks are going to get affected, right? So these notebooks, the second step, that is after journal, we are classifying it to various smaller notebooks, but specific notebooks. We're going to call them as ledger, okay? So, and we're also going to call them as account. Like, we are not going to call it as cash notebook anymore. We're going to call it as cash account. Similarly, groundnut, we are not going to call it as groundnut notebook. We're going to call it as groundnut account, okay? Yeah. So, what people understood was, in any transaction, economic benefit flows from one account to another account, like cash account to groundnut account when you purchase groundnut. When you sell an asset is going outside, so economic benefit flows from asset account, and that is getting converted to cash and coming inside. So the destination is cash account, and the account in which the economic benefit flows from, that account has to be credited. That is what we talked about in the previous video, understanding debit and credit. In case you haven't watched that video, please go and watch that video. Understood? It is video number 7. Understood? Yeah. So that the account from where economic benefit flows from should be is credited, and the account to which the economic benefit flows to, the destination of the economic benefit, is debited. For instance, if I purchase groundnut with cash, groundnut account has to be debited and cash account has to be credited. Now I want to write this when the transaction takes place itself. I want to give these details in the journal. Like when I'm writing the journal, I won't write like groundnut account should be debited and cash account should be credited. Understood? Now, In order to do that in an understandable manner, I have to give some universal rules that every accountant can easily understand and also apply. Now that those rules are called the golden rules of accounting. Now these rules were created for three categories of accounts. They created three categories into which every account in the business can be put into. Like if you take an account, it will definitely be it will definitely fit into any one of the three categories that they created. The three categories of types of accounts that headings of accounts that they created are real, nominal, and personal. Understood? So every asset account in the business comes under the category called real, and every nominal account in the business, by nominal I mean expenses, losses, income and gain. Every expenses, losses, income or gain comes under the category called nominal. And every account that is related to a person, real, natural person, or an artificial person like company or a partnership firm or a business, some entity that can be separately recognized and does business with our business, that person, which may be artificial person, that is a personal account. Okay, so they created three categories called real, nominal and personal. They created three accounts called real, nominal and personal, and put all the asset accounts under the real category, all expenses, losses, income and gain accounts under nominal category, on all accounts related to people, personals under the personal category. Now by persons we not only mean real people but also artificial people like organizations and all that. Okay, now when you look at it, if you want to test it, you can take any account and see if they fit into any one of these three categories or not. For instance, assume I am taking rent account. Now what is rent? Rent is an expense, so it will come under the nominal category. Similarly, if I take Ram account, Ram is a person, he will come under Ram category. If I take let's say loan account, loan is something that is given by a person, so that also comes under a personal account under representative personal account, representative personal category. Understood? And let's say car comes under car is an asset for the business, so it will come under the asset account. I purchased groundnut. I have not yet used groundnut, I have only purchased it. So purchased, whatever groundnut I purchase is an asset and therefore it will come under real account. Okay, so every category, every account will fall under any one of these three categories. So if you give rules that are specific to these categories, then you can probably give rules for every transaction that is happening, because you will be giving rules for every accounts, and transactions are basically nothing but flow of economic benefit from one account to another account. So both the accounts, if there are specific rules for these accounts, then you can probably write according to those rules in the journal. Understood? Now how to practically write and all, I'll do it in a couple of days from now. How to use these rules practically and write it in the journal, I'll do a video in a couple of days from now and solve a lot of record a lot of transactions in the journal applying these rules. But as of now, just understand the rules. Okay, an asset, when you look at an asset, it will either come into the business or go outside the business, right? So the rule for real accounts, all the real accounts, is debit what comes in, credit what goes out. So when I purchase groundnut for cash, groundnut comes in and cash goes out, right? Both of them are assets. So I'll apply the rule debit what comes in and credit what goes out and write it in the journal. So I'll write groundnut account debit to cash account. I'll not be writing groundnut account, I'll be writing purchase account, but that we'll get to when I'm actually teaching you journal. Understood? Similarly, for nominal accounts, expenses and losses can incur or you can earn income and gain, right? So the rule is debit all expenses and losses and credit all income and gain. And for personal account, personal means people basically, right? So people will either give money or take money from you, whether they are artificial, natural or representative. I'll explain what artificial, natural and representative are again while solving journal entries when we come across those accounts. Understood? As of now, just put them all under personal account. I just remember that under personal account there are three more categories, which are artificial, natural and personal. Artificial, natural and representative, but all of them have the same rule, that is either people will give money or take money, right? So the rule for personal account is debit the receiver and credit the giver. Now these three rules are formed or have been derived under the from the dual aspect concept. Now dual aspect concept gives rise to an equation called asset is equal to equity plus liabilities, and from that concept only we have derived these rules. But we will get to how we derive these rules from that concept in the video in which I'll explain about dual aspect. That also we will do it under a later point. As of now, I'm just giving you the basics for learning how to record. Understood? The golden rules of accounting is, for real account, all accounts that are real, the rule is debit what comes in, credit what goes out. All accounts that are nominal, debit all expenses and losses, credit all income and gain. For all accounts that are personal, debit the receiver, credit the giver. I'll give you an example of, I'll give you a transaction for example, and I'll teach you how to record that using the golden rules. Okay, just one transaction now as of now. Assume your business paid rent rupees 500 in cash. Okay. Now, when a transaction takes place, economic benefit flows from one source to a destination, right? In this case, cash is the giver of the economic benefit because you're paying using cash, right? And the source is, the destination is rent expense, accommodation expense that you've got, correct? So these are the two accounts that are getting affected. So identify the accounts that are getting affected and identify which category they fall into. Cash is an asset. Cash is an asset, right? Asset falls under the category called real. So cash will come under real category, and rent is an expense. Rent falls under the category called expenses and losses. Now again, income and gain fall under nominal account. So it falls under nominal. Understood? Now the golden rule for real is debit what comes in, credit what goes out. In this case, I have paid cash of rupees 500. Understood? So cash is going out. If cash goes out, I am supposed to credit it. Credit what goes out. And for rent, it is a nominal expense, nominal account. The rule is debit all expenses and losses. Rent is an expense, and therefore I am supposed to debit it. Debit all expenses and losses. Amount is 500. Now I am supposed to record this in the journal, giving details of the amount, the accounts that are getting affected, and if I am debiting that account or crediting that account, so that it will be easy for me to classify the transaction to the ledger. Understood? Now how to exactly record that and what columns you need to make in journal, all of that I'll tell you in the couple of classes from now, because in the next class I'll be teaching you modern approach, which also gives you a set of rules that talks about how to record transactions in journal, and whether you use modern approach or traditional approach, whether you use the rules that have been created under traditional approach or modern approach, you'll get the same journal entry. You'll get the same format in which you're supposed to record. So in this class, I have taught you about golden rules of accounting and traditional approach. In the next class, I'll teach you about modern approach, and in a couple of classes from now, that is after the class in which I teach modern approach, I'll take up a lot of transaction and I'll give you the logic behind how to use golden approach, traditional approach, and use golden rules as well as modern approach, and use those set of rules and create a journal entry in the books of accounts. Understood? That is, we'll take a lot of transactions and record it in the books of accounts according to traditional approach and modern approach, and we'll understand how they are both the same actually, and in what format we are supposed to record the transactions and all that. So keep watching and see you soon. Bye.